Are TFSAs good for small business owners? So as a small business owner, what do you do when your corp generates more income than you need for your daily operation or for your personal expenses? The decision to save that surplus is important. And what do you do with it? Do you keep it in the business or do you invest it personally? So let's explore some options so that you can secure a stronger financial future. Hi, my name is Laurent Munier and I'm a partner at Safe Pacific Financial here in Vancouver, Canada. And welcome if you've never seen us, and welcome back if you've been here before and watched all our videos. One of the main tax advantage accounts that you can use in Canada is the TFSA, which is your tax-free savings account. This is one of our favorite options for saving money and for building wealth over the long term. We are big fans of the TFSA. And so today, we're going to talk about how good the TFSA is for small business owners in Canada. I'm going to use some case studies here, and I'm getting that information from a Sun Life document. I'm going to link the original document below if you're watching on YouTube, or if you're watching on a social media site, comment the word Sun Life and I'll DM it to you right away. What is a TFSA? So I'm going to make this part pretty quick because we also just posted a more comprehensive video about TFSAs that you can watch. It'll be linked in the description, or you can click somewhere on the screen because YouTube is going to suggest it to you. TFSAs were introduced in 2009. They allow any Canadian 18 or older that has a valid social insurance number to save and invest tax-free. The contributions that you put into the account are not tax deductible, but anything that you earn, whether that's interest or capital gains or dividends, is tax-free even when you withdraw it. So let's jump into this topic. The tax benefit for the small business in Canada, and this is where we want to understand your corporate tax rate versus your personal tax rate. Many small businesses in Canada benefit from your favorable tax rate on your active business income, which is generally referred to as the general rate. And then the combined federal and provincial general rate, depending on the province that you live in, is between 23 to 31% across Canada. If you're a small business, you can also take advantage of what's called the small business deduction on your net income up to $500,000. So this is called the small business rate. And the combined federal and provincial rate under the small business rate, again, depending on your province, is between 9 to 12% on the first $500,000 of net income. Your personal tax rate is usually higher than your corporate active tax rate. So for, ordinary income, your highest combined marginal tax rate can be more than 50%. So Big Daddy Government is your partner in every dollar that you earn, and his big fat goons at the CRA are out to collect, and they're going to get their money. It gets a little bit more technical when it comes to paying yourself dividends. So I'm going to try to break this down in a very simple way. So for dividends, the highest combined rate, federal and provincial rate, is between 28 to 46% on eligible dividends, and it's 37 to 49% on non-eligible dividends. So the lower personal tax rate on the dividends is because that money's already been taxed corporately before it got paid out to you as a dividend. So eligible dividends are based on the general tax rate, and the non-eligible dividends are based on your small business rate that you've already paid inside the corporation. So your corporate versus your personal investments. So you want to understand where you have a tax deferral opportunity. So that doesn't mean you're not going to pay tax. That means you're not going to pay tax now. So unlike contributions to your RRSP, which gets an upfront tax deferral, both the TFSA and investing in your corporation starts with after-tax money. So you don't get any sort of deductions upfront. The difference is where the after-tax money originates. So for the TFSA, these are personal dollars. So you've paid income tax to take the money out of your corporation. When you invest corporately, that investment is with after-tax corporate dollars. So you haven't taken the money out personally yet. It stays in your company and you've paid corporate tax on it. If your corporation's tax rate is lower than your personal tax rate, you benefit from that tax deferral. So as the corporation keeps more money, they keep more after-tax dollars to invest. When you invest corporately, you can grow this after-tax money with cheaper dollars, right? But you still can't take that money and go out and buy a pair of shoes with that because you haven't taken it out as income. So, you still have to get it out of your corporation if you're going to spend it personally. And then to do that, there's going to be some sort of income tax, right? And then this is something that you work out with your accountant. How much do you need to pay yourself? What's your tax rate? And how can you, the tax stuff, talk to your accountant. So the potential for the tax deferral, it varies across Canada. So for corporate income tax at the small business rate, the potential tax deferral here is anywhere from 32 to 43%, right? So this is valuable and it's worth paying attention to. And for the corporate income that's taxed at a general rate, the deferral is again, depending on your province, anywhere from 17 to 27%. So to calculate what your specific tax deferral is, you subtract your corporation's tax rate from your current personal tax rate. So whatever you would pay income tax minus whatever your corp pays, the difference there is your deferral opportunity. So some key considerations to maximize your tax deferral in your corporate investments. So now a lower tax rate inside the corporation doesn't automatically guarantee a tax deferral advantage, right? So the goal is to maximize your after-tax personal income when you cash out the investment and you put the money in your pocket at the end of the day. So like investing in the RRSP, there's several factors that influence your outcome. And then these can include your corporation's initial tax rate on their active business income, right? So whether you're taxed as a small business or whether you're taxed at the general rate. You also want to consider your personal tax bracket at the time of your investment versus when you're going to cash it out and want to spend the money. And another big consideration is the type of investment income that you're going to get, right? So are you earning interest or are you earning dividends or are you getting capital gains, right? Or deferred gains. And then the last one that you really want to think about is your time horizon for how long are you going to keep the money invested and when are you going to need it? So is this money that you're saving for a couple of years and then you're going to pull it out to buy something? Or is this money that you're saving for retirement and maybe you're saving it for 10 or 20 or 30 years? So that is going to make a huge difference in where do you invest the money and how do you invest the money. These are the things that you really want to think about when you're trying to optimize your wealth building over the long term, right? And you have to be strategic in when and where do you pull income from and where do you invest and what do you invest in. This can be very complicated if this isn't what you do every day. So again, working with a good financial advisor like us and working with your accountant on a regular basis can help you to figure out how to invest, what to invest in, and when to invest, and when is a good time to pull money out, when's a good time to put money in. Now, different investments have different characteristics. So when you're comparing investment options inside your TFSA and inside your corporation, there's differences in the tax implications and in how that money grows. So for the business owner, when you're deciding whether you invest inside your TFSA or whether you keep the money in the corp, you need to understand the tax landscape at that time, and that's really important. So for the TFSA, the contribution comes from after-tax personal income. So that means you have paid personal tax at whatever your rate is when you take the money from the corp and you pay it to yourself, and then you invest it into the TFSA. Once the money's inside the TFSA, the growth is tax-free. And that means there's no additional tax on the interest or dividends or capital gains that's generated by the investments here. One little caveat is that if you're earning dividends from American companies, the IRS does not recognize TFSAs, and they are going to tax your dividends at source before you get them. But on the Canadian side from the CRA, nothing is taxable inside your TFSA. And even more, the withdrawals from your TFSA are completely tax-free. So this is a great option for, building personal wealth. So let's contrast. Your corporate investment, you pay the corporate tax at either the general rate or the small business rate, depending on how big your company is. And then when the investments are made inside the corp, the growth is taxable depending on the type of investment income, right? So if you're earning interest, so say you bought a GIC and you're getting interest, that's taxed anywhere from 46 to 54% inside your corporation. So like half. If you invested in a Canadian company and you're earning Canadian dividends, that's taxed at 38%. And then capital gains are now taxed at higher because the inclusion rate has gone up from 50% earlier this year to now it's 66%. So earning capital gains is now more expensive. So when you're investing inside your corporation, you've got the initial advantage of the lower corporate income tax rate before you invest the money. After you've invested inside the company, there's no tax benefits on the investment. So any investments inside your corporations are automatically taxed at whatever the highest rate is for that type of income. There's also passive investment tax credits, which is called your refundable dividend tax on hand. You'll see this as RDTOH. That can recoup some of the taxes that were paid when your dividends are distributed to shareholders. So while the TFSA provides tax-free growth and tax-free withdrawals, your corporate investments offer some tax deferral advantages. And so when the funds are eventually distributed from the corporation, they might be subject to either capital gains tax or a dividend tax, depending on how they're structured. And so as a business owner, you got to weigh the benefits of the tax-free growth inside the TFSA versus the corporate tax deferral. You need to determine which investment vehicle is going to get you a better after-tax return after you've sold everything and you've taken the money and you want to go and spend it at a restaurant or buy a pair of shoes or whatever you're going to do. So which option is best for you? Is it the TFSA or is it investing inside your corporation? So let's make up this guy, Andre. And again, this is the case study from the Sun Life document. And we'll talk about Andre's financial situation. He's a resident of Ontario. He's maxed out his RRSP contributions, and he's now in the highest tax bracket. His corporation is also based in Ontario. And at the end of the year, it has a $10,000 pre-tax surplus that's available to invest. So he's got 10 grand in his corp to invest. Let's see what happens if he pays himself the money and puts it inside his TFSA. So if Andre's corp pays him a salary, the corporation deducts the $10,000 from the company's pre-tax profit. So this reduces the corporation's taxable income to zero. And then Andre receives the $10,000, but Andre pays personal income tax at a rate of 53%. So this leaves him with $4,647 to invest in his TFSA. So he started with $10,000 and he's now got $4,600 to invest in the TFSA. Let's see what happens if he keeps the money inside the corporation and invests. If the corp retains the $10,000, then the after-tax amount that's available for investment, it'll depend on the corporation's tax rate. So if it's a small business, he's going to pay a 12% corporate tax rate. So he'll have left $8,780 to invest. If it's not a small business and he's paying at the general rate, which is 26.5%, then he's going to have $7,350 to invest. So the corporation invests this money after, and the corporate investment income is subject to corporate tax on either his interest or dividends or capital gains or whatever type of income that this investment is earning. Also, you got to note that the federal government just recently increased the capital gains inclusion, which impacts the passive income tax on corporate investments. And then here's the analysis, right? Is it better for Andre to pay himself the money and invest in the TFSA, or to keep the money in the corporation and invest it inside the corporation? And so to make a fair comparison, he's going to invest in the same thing both ways, right? He's going to invest whatever after-tax amount into a balanced portfolio that gets 5% a year. And that 5% in the portfolio is divided amongst interest, dividends, and capital gains. So he's got a blend of types of income. And to see the benefit, we're going to evaluate the after-tax value of both once he withdraws it. So whether he takes it from the TFSA or he takes it from the corporation. And then the analysis will help to determine, what's the best strategy for Andre, our boy Andre here, on the long-term financial plan based on the current tax situation here in Canada. So the article provides a wonderful graph, and here's the graph up on the screen so you can see what we're talking about. So when the corporation pays tax at the small business rate, the TFSA outperforms the corporate investment almost immediately. And then because the capital gains inclusion in the 2024 budget went up, the initial amount available from the corporation is actually lower, both right at the beginning and over the long term. So this is obviously due to increased taxes on the corporate capital gains. So the TFSA outperforms early on, but it takes some time for that difference to exceed, to come to like a big number, right? So to exceed 1%. So it's important to note that the lower interest income generated inside the corporation, the better the corporate investment is. However, it's important to know that your investment strategy should also align with your risk tolerance. So like, what are you investing in? You should invest in something that suits you. You don't select investments just for tax performance, right? You should invest in things that make sense for you and then think about taxes. You don't think about taxes and then invest. So for instance, you can have a corporate class mutual fund, and then this can reduce your interest generating investments, but the returns on these mutual funds, like, is it good? And it goes up and down. So it's obviously important to consult with your financial advisor to make sure that whatever your investments are, that matches your risk tolerance and also your long-term financial goals. The new capital gains inclusion rate has also impacted corporate investments, particularly with the increased tax on capital gains. So investing in your TFSA was better before, but now it's even more better. Yes, I know I said more better, and that's just to make sure that you're still paying attention. More better. So this analysis changes, really, depending on your province. And the performance of the TFSA versus corporate investments, it really depends on your tax rate across the different provinces. And in each case, we'll analyze how long does it take for the TFSA to outperform the corporate investment by at least 1%. And you want to understand, how do these tax changes affect your investment strategy? And this is obviously very important for maximizing your long-term gains. For tailored investment strategies and to really understand how do these changes affect your financial situation, talk to us or talk to your financial advisor. We can guide you and help to make sure that you know all the details. These things change all the time, and it's really probably not your job to stay on top of these things, but it is our job to stay on top of these things. So, we know this and we talk about it all day, every day, and we can help you. When you're doing your TFSA, pay yourself the income, put it in the TFSA, or keep it in the corporation and invest. How long does it need for that TFSA to outperform the corporate investment by 1%, depending on your personal tax bracket? So, how long does it take for that TFSA to outperform, assuming that you remain in the same tax bracket for the rest of your life? And so here we're going to show you 3 different tax brackets. So if you're in the second federal tax bracket, which means you're earning around $56,000 a year, or in the third federal tax bracket, which means you're making around $112,000 a year, or if you're in the highest federal tax bracket, which means you're making, $246,000 or more in annual income. So when your corporation pays tax at the small business rate, the TFSA typically starts providing more after-tax returns right away. And then since the 2024 federal budget made changes to the capital gains inclusion, the time needed for the TFSA to beat the corporate investments by more than 1% is actually quicker, because now the corporate capital gains cost more. So yay, more taxes. And so you can see here a visual representation of how many years does each tax bracket does it take for the TFSA to outperform the corporate investment over time. So you can see here a visual representation of how many years for each tax bracket in each province does it take. So when we want to compare your TFSA to RRSP investments, right? How does this compare? So interestingly, the timeline for the TFSA to outperform the corporate investment is essentially the same as the RRSP analysis. So if you stay in the same tax bracket for the rest of your life, the after-tax returns from both TFSA and RRSP investments will be identical once you liquidate. So this is because your RRSP and your TFSAs grow tax-free, and they maintain a consistent tax rate. So that means that neither will have an advantage over the other in the long term. So understanding how your TFSA and your corporate investment and your RRSP perform in relation to your tax bracket is actually really important for optimizing your investment strategy and achieving the best after-tax return. So there's also an impact when you're changing tax brackets when you cash out the funds, right? So if you're in a lower tax bracket when you withdraw the money, like there's the RRSP analysis, this will obviously impact your outcome. If you move to a lower tax bracket between when you start investing and when you cash it out, it actually takes longer for the TFSA to outperform the corporate investments. So again, depends. Are you going to make more money later, or are you going to make less money later? Which tax bracket are you going to be in? So in this scenario, the corporate tax deferral becomes worth more because initially you're withdrawing corporate funds at a higher tax rate and you're investing in the TFSA, but later you're removing those funds from the corporation at a lower rate. So for the corporation that's paying tax at the small business rate, the TFSA often takes, longer time to outperform the corporate investment. Sometimes, again, like on the example here, 18 to 30 years, again, depending on your province but 18 to 30 years for the TFSA to outperform the corporate investment by more than 1%. And this is obviously due to a larger tax deferral at the small business rate. So you're paying cheaper corporate dollars up front. And the more tax brackets that you drop later, the longer it takes for that TFSA to catch up. If you're at the general rate, so if your corporation's making more than $500,000 net at the end of the year, the TFSA outperforms the corporate investments really quickly because the tax deferral advantage is smaller. But it's still going to take 10 plus years for the TFSA to outperform by more than 1% in the example that we're showing. Again, if you drop tax brackets when you're withdrawing the funds later, this also extends the time that it takes for the TFSA to outperform the corporate investments. So the biggest TFSA outperformance is in the higher tax bracket. So if you move to a higher tax bracket when you're withdrawing funds, that tax-free growth from the TFSA becomes way more significant. So in this case, you initially take the funds from your corporation at a lower tax rate and invest in a TFSA tax-free. Then later, when you withdraw the corporate investments at a higher tax rate, so this makes those TFSAs up front a more favorable option. Regardless of whether your corporation pays the small business rate or the general rate, the TFSA outperforms from the start, and it continues to have an advantage in this case, right? So some other things that you want to think about. There's several factors to consider when you're trying to decide, do I leave the money in the corporation and invest, or do I take it out and put it in my TFSA? Number one is you've got the TFSA contribution limit. The TFSA has a use it or lose it rule, meaning that you can't contribute after death. So your estate can't make contributions to a TFSA like it can to a spousal RRSP. So any unused contribution room is gone when you pass away. Also, your investment goals. So the TFSA can be used for both short-term and long-term goals. Generally, your RRSP is primarily for retirement, so it's a longer-term timeline, and your goals and your timelines are going to influence your decisions on where do you put your money and what do you invest in. The impact on your income-tested benefits. So this will be things like your CPP and your OAS and retirement. So when you take money out of your TFSA, this doesn't affect income-tested benefits, whereas corporate dividends or RRSPs could. When you're thinking about income splitting, so you want to make sure that you're on top of the income splitting rules, and this obviously will impact your decision. Do you use the funds corporately, or do you pay yourself income and put it in TFSA? And then also there's the passive income accumulation. So if your corporation is accumulating passive income, you could lose your small business rate, right? So these again are sort of new rules that came in with our last finance minister, really to try to discourage people from investing inside their corporation. And then from an estate plan perspective, you've got post-mortem planning. So keeping the funds in the corporation may complicate your estate planning, and it may increase the costs of executing your estate plan. And again, it really depends on kind of like the volume of money that we're talking about, whether you're investing inside your corporation over the long term and from an estate planning perspective. And here you want to talk to your estate planning lawyer, and you definitely want to talk to your financial advisor who understands this kind of stuff. Then we talked a little bit about RDTOH, right? Your refundable dividend tax on hand. So you can recoup this, and you want to plan to recover this if the funds are inside the corporation. And this is something that you talk to your accountant about. So in the summary, we're getting to the end here. So the TFSA versus corporate investments for Canadian business owners, which one is better? For most business owners, the TFSA for future savings makes sense, especially since the federal government changed the rules on capital gains in the 2024 budget, which makes capital gains higher taxed. Yay, higher taxes. However, the decision isn't always straightforward. The time that it takes for the TFSA to outperform your corporate investment depends on a bunch of factors, including whatever your current and future tax bracket is on a personal level, on your current corporate tax rate, whether you're at the small business rate or at the general rate, and when do you plan on taking this money out? This information that I've given you here is just a guideline, and it also should give you some questions to think about when you're talking to your financial advisor or your accountant, when you're making these decisions based on your financial goals and on your family circumstances, right? So today's video is a bit more technical than our regular ones. So if you got any questions, reach out. I love to talk about this stuff. I can talk about this stuff all day if you let me. But this is why we're here on YouTube, and we're going to cut it because otherwise this video is going to be way too long. If you've got money inside your corporation and you're wondering what is the best way to invest it and grow it, contact us. We can help you. This is what we do all day. Our team is very good at this, and we can put you in the right types of account depending on your financial goals so that we can help you reach those goals in a quicker and smoother way, while also not distracting you from your number one wealth generator, right? Don't forget, you're probably going to make the most amount of money inside your business, and that's where the majority of your focus should be. So everything I've talked about right now, you should consider, but you should also not take your eye on the ball of make money in your business. That's where you're going to make the most. All of this other stuff, this is what we worry about. You worry about making another widget, selling more services, increasing your prices, getting more customers. You will make way more money doing that. So if you gained value watching this video today, please do all the things that make the robots love us. So that means click like, click subscribe, click share. If you've got any questions, leave a comment below. I know this is a technical video and there's probably a bunch of questions. You know, general rate versus small business rate, what's RDTOH, what's NerdTO. If you want to chat about investing, you know, we've been advising hundreds of clients about this for more than a decade. How do you get a hold of us? You leave a comment below or you contact us through our website. It's safepacific.com. Any messages that you send through there, somebody on the team will get back to you in 24 hours on business days and we'll set up a time to meet. We're licensed across the country, so we meet people all across Canada. All our meetings are via Zoom, so we can meet you at your time from wherever you are. That's it for today. I will see you next time.